Let's cover 6 major tax updates that were announced in the budget on Wednesday and how they could impact you. If you're new to my channel, I'm Kiran. I'm a qualified chartered accountant and experienced tax professional. Let's start off with one that will impact all of us, and that's the freeze to income tax thresholds. The biggest tax raising measure has been to freeze income tax thresholds, and it's expected to raise £12 billion. This doesn't look like a tax hike because the headline tax rate for tax on salaries has not increased. Instead, thresholds have remained the same. So this is effectively a stealth tax because it results in something called fiscal drag. By keeping thresholds as they are, it means that as your salary increases because of inflation, those thresholds are going to stay the same, so you are going to be pushed into paying tax at the higher rates, 40 and 45%. And then if you are not paying tax at the minute because your salary is below £12,570, it's likely that you will be pushed into paying tax for the first time as your salary exceeds the personal allowance. At the moment, we have around 1 in 5 people paying tax at the higher and additional rates of 40 and 45%, but it's actually expected that that's going to increase to 1 in 4 people in 5 years' time as a result of these thresholds staying the same. And just to be clear, the Conservative government did freeze these thresholds until 2028, but what Labour have done is they have frozen them for an additional 3 years to April 2031. The OBR's Economic and Fiscal Report revised its March forecast and now estimates that because of that extended freeze to the thresholds, we'll have an additional 780,000 basic rate taxpayers, almost 1 million more higher rate taxpayers, and 4,000 more additional rate taxpayers. I will leave a link to that report in the description box, and you can look at page 11 to see those numbers that I referred to. But essentially, this is a tax that relies on inflation in order to work effectively, and it means that we will all end up paying much more income tax. Also remember that it's not just income tax that's impacted, because when you get tipped into the next tax band, for example, if you get tipped from the basic rate band to the higher rate band, then that will also impact things like your capital gains tax rate. So if you dispose of a residential property, you will be liable to pay tax at 24% on that gain as a higher rate taxpayer rather than 18% as a basic rate taxpayer. It also impacts your dividend tax rates, which I will talk about later, and it also impacts your personal savings allowance, which is the amount of savings interest that you can earn tax-free before you have to start paying tax on that interest. So for basic rate taxpayers, that's £1,000, and for higher rate taxpayers, it's £500, and for additional rate taxpayers, it's £0. Now let's talk about the new separate property income tax rates. From April 2027, we are going to have separate property tax rates for individual landlords receiving rental income for property held in their individual names rather than through companies. So at the moment, if you are a private landlord, you will pay income tax on your rental profits, and those rates are 20%, 40% and 45%, depending on whether you're a basic rate, higher rate or additional rate taxpayer. What will happen from April 2027 is that we will see separate property tax rates, and they are higher than the standard income tax rates. So they will be 22%, 42% and 47%. Also remember that if you are a private landlord, you cannot deduct any mortgage interest in full. Instead, your mortgage interest relief is capped at a 20% credit of that mortgage interest. So what will happen from April 2027 is that credit will also be increased to 22% in line with the property tax basic rate. HMRC say that less than 10% of taxpayers have taxable property income. So they're saying that this tax measure is not going to impact the vast majority of people. But most people who own property as individuals are not huge landlords with hundreds of properties. They are individuals who might own 1 or 2 properties, potentially by accident, people who have inherited property, or sometimes it's people who have started on the property ladder, and as they've moved up, they've been able to keep their first house and rent it out. So they are targeting the wrong type of person here, in my opinion. They are just targeting the average person who's not going to be able to absorb that increase in tax rate. Instead, what they'll do is they will probably increase their rent. So in April 2027, we might see an increase in rent because of the new property income tax rates. Most likely, we'll also see people buying property through companies rather than individually, because there's already a tax advantage there, because companies can deduct mortgage interest in full rather than that 20% credit that individuals are limited to. Next, let's talk about the increase to savings income tax rates. Tax on savings interest is also increasing at each tax band. So the basic rate tax band for savings interest is going from 20% to 22%. The higher rate band is going from 40% to 42%, and the additional rate is going from 45% to 47%. This only applies to savings that are held outside of an ISA, because if all of your cash savings are in an ISA, then any interest that you make is sheltered from tax, because ISAs serve as tax wrappers. And that's why HMRC say that less than 10% of people are impacted by this tax increase, because the vast majority of people do not have enough savings to start paying tax on any interest that those savings generate. Because if you're a basic rate taxpayer, you can earn up to £1,000 of interest before you have to start paying any tax on it. If you're a higher rate taxpayer, you can earn up to £500, and additional rate taxpayers can't earn any tax-free interest on their savings. But according to AJ Bell, 2.64 million people this tax year will need to pay tax on their savings interest, and 44% of those people are pensioners. That's why I think this is an unfair tax, because the government are really going for the wrong person to raise tax revenue. They are going for pensioners, people who have worked for a long time to build a healthy savings pot for retirement, and who will now need to pay a higher rate of tax on any savings interest that they earn. And arguably, yes, it is only savings interest. It's not your actual savings that you have to pay tax on. But I still think it's an unfair tax. Let me know what you think in the comments. Now let's talk about the increased tax on dividends. Dividends received from assets held outside of an ISA are subject to tax. That's the current tax rule, and that's not changing, but the rates are changing. So the current dividend tax rates are 8.75% for basic rate taxpayers, 33.75% for higher rate taxpayers, and 39.35% for additional rate taxpayers. So the basic rate of dividend tax is going to go up to 10.75%, and the higher rate is going up to 35.75%. The additional rate is staying the same at 39.35%. The £500 dividend allowance is staying the same, which means that you can earn £500 of dividends before any tax is payable on that dividend. That allowance is not very good anyway. It used to be much higher at £5,000, and it's been reducing every few years, and it's now £500. And I guess it's better than nothing, but it's not actually very much. So this particular increase is going to impact small business owners who often have dividends as a key part of their remuneration package. I'm going to go through an example so you can see how it would work, and I'm going to use a combination that's quite common because it keeps the business owner within the basic rate band and doesn't tip them into the higher rate band. So what lots of business owners will do is they will take out a salary of £12,570, which is equivalent to the personal allowance. So it means that no tax is payable on that salary. And then they will take out dividends of £37,700. And once that £500 dividend allowance has been claimed, that business owner will have £3,255 to pay on that remuneration package. Once these dividend tax rates have increased from April 2026, that business owner will have to pay tax of £3,999, which is an increase of £700 on that particular remuneration package. Next, let's talk about the order of taxation. Something quite small, but that has the potential to impact quite a lot of people is the order of taxation. That is the order in which your income gets taxed. So at the moment, the first thing that gets taxed is your non-savings income. That includes employment income, pension income, property income, and also trading income if you're a sole trader. The next thing that gets taxed is your savings income, and then it's your dividend income. What's changing from April 2027 is that property income will be the second layer in the order of taxation. And that has an impact because the personal allowance follows that order. So that basically means that the personal allowance will be set off against employment income, pension income, and trading income first in priority before it's set off against your property income if you have any. So let's say that you're a private landlord and you earn most of your income, say £40,000, from rental properties that you own personally. And then let's say that you earn £10,000 from casual part-time employment. In that case, your personal allowance would be set off in priority against that employment income. And then you'd have £2,570 remaining to set off against your property income. And you don't have a choice about that because that is the new order. So even though your property income will be taxed at a higher rate from April 2027, you have no choice about where that personal allowance gets offset first. So private landlords are going to be in an even worse position because not only are the property income tax rates increasing by 2% at each tax band, but we also have this order of taxation which puts property income second in the list. Finally, let's talk about the change to the cash ISA limit. There was so much speculation about the cash ISA limit being cut ahead of the budget, and people were right because the cash ISA limit will be cut to £12,000 from April 2027 unless you're aged over 65, because then you can continue putting £20,000 a year into your cash ISA. That cut to £12,000 is within the overall limit of £20,000 across all ISAs, which hasn't changed. So apparently this is to get people investing into stocks and shares, but it's questionable whether cutting the cash ISA limit will be enough to change behaviour, because according to a survey by AJ Bell, most cash ISA savers would just put any excess into a taxable savings account. And the problem there is that if you put your money into a regular non-ISA account, if you start saving enough and earning enough interest, that interest could be subject to tax, like we spoke about earlier, and those tax rates on savings interests are also set to increase from 2027. So what you need to do here is to keep an eye on the savings you have that are held outside of an ISA, and to make sure you know how much interest you're earning and whether you're about to exceed your personal savings allowance. And if you are, make sure you are maximizing your cash ISA allowance, and then decide whether you want to invest in stocks and shares instead of putting more money into cash where your interest could start to get taxed. If you like this video, then please hit the subscribe button because it really will help the channel to grow. Thanks for watching, and I'll see you next time.